two assignments going in parallel. One, which is very complicated, which I broke down into steps, which is to calculate a risk parity portfolio. It's the most difficult thing we'll do in this course, and we will finish maybe next week or the week after. And I want to know how you are doing with that, if anybody has a comment on that assignment. I also want to ask you about the assignment that I gave you last week, which is different, completely different, and requires that you get data from the from the Hong Kong Stock Exchange. Okay, so on the first assignment, is it, how is it going? Is it very complicated? Do you know what the end game is? Are there any questions on the first assignment, the one which is going for several weeks now? Any questions? Is it too easy? Is it, I don't know. I have difficulty understanding if you find it easy or hard or just right. That's why I changed and I broke it down into steps. I don't know how much practical experience you have dealing with data and complex algorithms. So, any comments? No? Okay, let's talk about the other assignment. I asked you to download some data about stocks, but this is not prices. I asked you to download volumes, and I want to know how that is going. You were able to find the data? You were too busy to, very little experience. Okay, can I help you? Getting the volumes information. Is that something that you were able to find? It's all online. I want to know. So let me ask a question. Okay, I want to understand if, because this is a very good assignment if you can do it. Can you get the information about the stocks in the Hang Seng Index? Are you able to do that? The names of the stocks. It's 30 stocks, 30 components. Okay, maybe I show you. I'll show you. Screen. I think it's this one. There you go. So in this website, you can see what can we see here? We can see the stock, okay, the name, the price, and the volume. This is what we care about. The volume. Okay, we need to know for each of the stocks, we need to know, you have to do a little bit of research. You have to get the total number of shares and the daily volume of shares. Okay. That's what you have to do. And by the way, this is something that I'm happy if you collaborate on this. If you, again, I don't know how you are doing this. I would like to know, but if you have difficulties doing this because you have to do it manually one by one, I don't know how you are doing this, then I'm happy that someone takes 2 stocks and then you just go down the list and then get all the information for all the stocks. I'm happy if you share the information. But this is it's a good example so that you see how these things are done. okay, and how it feels when you get all these data. Okay. So here I just got this of this search engine, but I'm assuming that this is the daily volume. So I think this is exactly that. Please check, but I think that's what it is. The volume of shares that traded that day. And then when you know the total number of shares, which you have to find elsewhere, then you can create the results that we were looking for in the assignment. Okay. Any questions? Okay, so I'm assuming this is clear, but please ask if it's not, okay? This is not hard. And if you don't know what you're doing, then your question will have a very simple answer. So you better ask, and then I can tell you. It's all going to be very simple. Okay. Okay, so today I'm going to continue then with what I was doing last week, which is this. So this is exactly where we ended. This is exactly what you have to do for the assignment. I asked you to do a table. If instead of it, I want you to do a table for the assignment. Okay, so you're going to do a table which contains the stocks, stock, and then the daily volume and the total number of shares. Okay, as a table. But then, as I explained last week, you could do this as a graph, where what you have here is the daily liquidity, which I remind you was the division. You divide this by that, okay? And then this is the asset size. Of course, when you're doing the index, this is not too relevant, but if you want to, again, you don't have to do this for the assignment, but if you were going to do this for the index, here you have to include in this calculation, you have to include the percentage weight of each stock in the index. Okay. Now the index is going to have these stocks fairly equally weighted. So this is not going to be, so this axis is not interesting for an index, but it's very interesting when you're dealing with a portfolio. This is a way to visualize the liquidity structure of your portfolio and a way to detect problems. Like I said the other day, if some of these points like this one is there, that's bad. And if it's there, it's good. Okay. Okay, so that's one way to visualize this. And this is part of risk management. It's something that you want to do because you want to make sure that your portfolio is balanced. Now, in the act of risk management, there are other things that you want to do. And now we're going to start talking about something which is new, and it's going to lead to a new set of considerations, which I don't know if you have seen before. But I will ask you a little bit later. Let me now continue with my discourse and talk about the concept of a stress test. What is this? When you have a portfolio, for a given portfolio, you want to know what the portfolio would have done in different conditions that happened in the past. This is sometimes, oh, there's a question here in the chat. Let me just check. Sorry, let me address this question. Oh, we cannot use Yahoo. Yes, I knew, but I am assuming that you have a way of getting the same information on Bing or some other search engine, okay, a Chinese search engine. This information is available on Yahoo, on Google, on everything. I used an English-speaking one. You can use a Chinese-speaking one or a Arabic speaking one. This information is given in any language. So I just showed you the page on Yahoo because that's the one that shows up when I do it, but you probably have a different one. And I'm sure the table is the same. You understand what I'm saying? There's nothing special about Yahoo. Yahoo is just getting information which is available. I'm sure the Hang Seng Index has a page themselves that you can access and you can get the information there directly. Okay, let me show you. Let me see if this is clear. Let me stop the share. Let me show you what I mean by this, okay? And actually, there's a chance maybe Ivy can help me with another search engine. I'm going to show you, okay? So here's another example to show you that you don't have to go to Yahoo, you can go anywhere. So just found this website. It's another one, it's the Investopedia, and it contains the information of the names. These are the names that we need there. And then you have to go and get the information about each of these stocks. Then you have to find, again, the same thing is the number of shares, the daily volume. Okay, you don't have to use Yahoo or Google or something like that. You can use any search engine. Okay. Yeah, is that clear? You don't need Yahoo. What is your favorite search? Which search engine do you use? I used to know, but I forgot. Clear? Is clear? Yeah. Yeah. Okay. Yahoo is the one that appears when I do my search. But for you, a different one will show up. And it's the same. You get the same information. The information comes from the exchange. The exchange is in Hong Kong. The information comes from Hong Kong. So that's why you can, yeah, you can get it. In fact, I'm sure that the original information is in Chinese and it's not even given to me by Yahoo. It's given, or by Google. It's given directly by the Hong Kong Stock Exchange. Okay, I cannot help you there because I don't know which search engine you would use for data in Hong Kong. But I'm assuming that you would know. Okay. If this was, and this is why I gave you the Hang Seng Index as the example. If I had given you the S&P 500, then I suspect that information might be more difficult for you to get. But I'm assuming the Hang Seng is very easy. There's no restrictions in mainland China to access the Hang Seng information, no restrictions whatsoever. Okay. Whether they're given to you by Yahoo or someone else. Okay, but this is good. It's a good question. You have to ask me these questions, okay? Because sometimes I'm afraid that you go down the wrong path, and then it's very easy to tell you, no, that's not the way you're supposed to go. You're supposed to go the other way. It's very easy, but you have to tell me. Good. All right. Good. Very good. All right. So let me go back then to sharing my lecture notes and here. Okay. So stress test. A stress test is when you take a portfolio and you put it through some scenario that happened in the past. So the concept of scenario is a very important one that is going to dominate everything we do today. Okay. So I hope you know what a scenario is. Scenario. It's an English word that means that something that happened. Okay. Something that happened or something that could happen. Okay. Something happening. There's another name for this. It's called what if. What if? It's what if analysis. You want to know what if something was going to happen. And I have 3 examples here of what if scenarios. I'm not sure if you can read this. It's called Black Monday. Okay. Black Monday refers to a day, which is October 19, 1987. That's Black Monday. Okay. It's one day where the markets dropped 25% in one day. It's still to this day the biggest one-day drop of any financial market. Okay, since 1929. So in the modern era, this is the biggest one-day drop, 25% in one day. It's called Black Monday. That day, you know what happened to every stock because it's all being recorded. There is a database. And just like you're finding information about the Hang Seng Index, you can find information about the S&P 500 or any stock that was being traded in those days. Okay. So that's Black Monday, October 19, 1987. September 11 attack, another bad day for the markets. That was September 11, 2001. And same thing, you know that that day certain things happen in the market. We have information, it's all retrievable and public, and you can analyze what your portfolio would have done on that day. Again, what if analysis. And there are others. We don't need to know what each ones are, but what you do is in stress tests is you select things that happened or could happen. You have to sometimes create your own scenarios, your own possibilities of something happening. And then what you do is you analyze what would happen to your portfolio. So here I have an example that I have a certain portfolio. Black Monday means the stock. Yes, thank you. This is a good comment. Black Monday means the stock market crash often occurs on Monday. Actually, so what happened is this particular day was a Monday. Okay, and bad things happen on Mondays. We already saw one. Remember the Volkswagen short squeeze that we described, the short squeeze of Volkswagen stock happened on a Monday. The reason is that news happened over the weekend, and these people, investors, have no way of acting on them until Monday. So Monday is a day of tension which has been accumulated through the weekend. And that's why usually Black Monday refers to the fact that a lot of these accidents happen on a Monday, but not always, okay? Not always. But Black Monday refers to this particular date. That's exactly the date. October 19, 1987 is the day that we call Black Monday. It's the worst Monday in history. So yeah, thanks, Lee, for the remark. Very good. And when you have a portfolio, your own portfolio, for example, we have a portfolio of the S&P 500, the Hang Seng Index, and the hedge fund index, the one that you are building the risk parity portfolio with. Once you have that portfolio, you can think, how good is this portfolio? And then part of the answer would be, well, what would happen on a bad day? What is a bad day? It could be September 11, 2001. It could be October 19, 1987. It could be some other day. And then you go and you see how bad things were. Then you may be asking, what do you do with this information? Well, right now, you do nothing. Very soon, we're going to be doing something with it. We're going to be taking the statistical consequences out of this event. But right now, you don't. You just record the information. So you see some things would be good. In bad days, when you have some stocks that do good, that's a lot of information. That's very good information, right? And then some things will be bad. So something will be good, something will be bad. What do you do with this information? Right now, nothing. You just collect it, okay? We're beginning now a new type of consideration, which is to look at the portfolio by focusing on the bad things. Remember, we've already done something like this. Remember in the snow swap example. In the snow swap example, we considered one case, which is what if all of the ski resorts go bankrupt? Remember, we discussed that? That's a type of scenario analysis. That's a type of stress test that you do. It doesn't mean that it's going to happen. You just want to know what would happen if that was to occur. What would be the impact on your portfolio? And this is very useful information. It's called stress test. So let me drive this forward, and let's go back to the portfolio distribution function that we saw many weeks ago and look at the stress test from this perspective. I remind you of what this graph means is the cumulative gains or losses, the cumulative gains or losses, okay? Gain is if the P&L is bigger. The P&L is bigger than zero. Losses is when the P&L is less than zero. P&L stands for the profit and loss. It's the value of the portfolio today minus the value of the portfolio yesterday. So when that number is positive, it's a gain. And when it's negative, it's a loss. And you can look at that P&L from two perspectives. From a statistical perspective with a histogram of actual performance, and through the cumulative P&L portfolio distribution in green. One is the derivative of the other. We saw this, a long time ago. And from this perspective, where you have not only what happened once, twice, or three times, but when you have an idea of the bad days are typically here. This is where the bad days are. The bad days are in this part of the distribution. So typically, Black Monday, September 11, they will be here. They will give you losses, and usually extreme losses. This is what the bad days are. This is what the good days are. Okay, so let me ask you a question. When you are investing, what do you care about? Do you care about the bad days or you care about the good days? Who can answer this question? Do you care about the good days? Do you care about the bad days? And this is not a question which is right or wrong. So a die cares about both. Anybody else wants to answer this question? Do you care about the bad days or do you care about the good days? B cares about both. Die cares about both. Maybe some of you, you're worried about the bad days only, but you don't want to say, oh, I only care about the bad days. You know, I'm very scared of the bad days. That's normal. And if you care about the bad days, okay, so who says bad days? Well, if you care about the bad days, then you are what's called risk averse. Risk averse. Risk averse people, they care about the bad days. What bad things could happen? Okay. And this affects not only investing, this affects everything. The pandemic, for example, right? You're very worried about being infected with the virus, and you only think about that. Then you're risk averse. You focus on the bad things. Some people are like that. Okay. Some people, they don't think about that. They think about the good days. They just think how much fun it would be if I could go to a party. Okay. Then you are what's called a risk taker. Some people like taking risks. Okay, some people like taking risks. Anybody here does sports? You play sports? Anybody play sports? Yes. Who plays sports? Okay, what sport do you play? Can you tell me? Yes, everybody plays sports. Of course, everybody does sports. Competitive sports, I mean, okay? Competitive basketball. Okay, so in basketball, when you play basketball, you play to defend and you play to score. You have defensive, badminton, another example. You play to defend, you play to score. Okay? When you play to defend, you're a risk manager. You don't want the opponent to win over you. And sometimes you just have to do it. Okay. Basketball, you are defending when the other team has the ball. Okay. Badminton, sometimes you're in an extreme situation. You just hope to return that serve or that ball given to you by the opponent. Sometimes you're in risk management mode. You just want not to lose the point. And other times you're aggressive. You want to win. Okay. So when you're investing, the mindset is very similar. You look at the portfolio from the two perspectives, whether you are defending, that's risk management, or whether you are on the offensive, which is you want good performance for your portfolio. Okay. Through most of these course, we have focused on the offensive, on getting good performance for the portfolio. We optimized our convertible arbitrage trade so that we have the optimal sub ratio. All of that is about being on the offensive. Like when you play sports, you play to win. But sometimes it's the opposite. You need to play defense. You need to look at your portfolio and think, what's the worst thing that could happen? Okay, what's the worst thing that could happen? So for those of you who answered that you play sports, I have a question for you. My question for you is here. Do you do this type of stress test analysis when you're playing sports? Yes, you do. Everybody does. When you're playing basketball, you're thinking, what if they come this way? What if they come that way? Well, that's scenario analysis. That's you're stress testing your own play. And then you make a decision. I'm going to move to the right. I'm going to move to the left. See, a stress test is something that we do every day. When we play sports, when we live, when we invest. And what I'm about to do today is I'm going to quantify all of this. In the case of investing, we can do this. We can quantify. When you're playing sports, you cannot quantify because you don't have enough time and you don't have a computer in front of you when you're playing. You have to do this mentally and very, very quickly. Today, we have time, so we can actually do this mathematically. We can write things down and we can figure out how these things would work if bad things happen. Today, we're going to focus on bad things happening. And I want you to think of either, sports. I'm looking for an analogy that will help you bring this down to earth. And sports is a good one, because when you play sports, you always do this. You just do it very quickly, unconsciously, and you have no time for calculations. But today, we can look at investing, thinking of what bad things could happen with the ability to actually calculate things. All right. So today we're going to focus on this part of the distribution. We're going to focus on this part of the distribution. That's where risk management happens. Some of you are worried about the bad days when you invest. That means that you're a risk manager. That means if you play sports, very likely, you're also thinking of how can they score a goal on me, or how can they score a basket on me, or how can they beat me? That's what you're thinking all the time. Maybe you think less about beating them. Okay. Some people are very good at thinking how to beat them, but then they don't look at how you can be beaten. And some other people are the true good ones. They are good at both. They're good at beating the opponent, but also they are good at protecting their play so that they are not beaten by the opponent. Okay, so today, risk management, that's what we're doing. We're only going to focus on the bad things. How can we do that? How can we focus on the bad things, on this bad part of the distribution? Okay, so there's certain measures, they're called risk measures. Risk measures, they give us an idea of how bad things could be when bad things happen. And they're going to be based on the quantile function of the portfolio distribution. Again, when you're investing, you have the advantage that you can do these things, you can mathematize these things. In other areas, you cannot. And actually, when you look at the pandemic has been interesting because governments have been trying to quantify these things. They have been trying to come up with numbers and make decisions based on numbers. The problem is that these things are very difficult to do. Sometimes they take years to build good systems. Okay, and a lot of the public policy decisions that you see are based on similar thinking as what we're doing today. So today we're just focusing on investing on portfolios, but these things have impact well beyond the world of investing. Okay, so I hope you understood this. And I'm going to now look at my first definition. It's called value at risk. It's a definition from 1994, very old. Well, very old by some standards, a triangle has an older definition than value at risk. So it's been with us for only a few years. And what that does is the following. It picks a confidence interval, usually 95%. Okay. And we're trying to understand the probability. We're trying to understand the number that we're going to lose with a probability of 5%. So very low probability, but that could happen with a probability of 5%. Okay, let me explain what this number is. I want to explain with an example. In fact, let me go to the example that I have here. Let me imagine that we issue 1,000 lottery tickets. 1,000. We issue. We don't buy. We issue. Okay. And the winner will get $1 million from us. Okay? So you will have to pay $1 million to someone you don't know who, and you have 1,000 tickets. So let's imagine that you only sell one ticket, only one. If you sell only one ticket, then the probability that you're going to lose money is very small, is 0.1%, because you only sold one ticket. Very likely, the $1 million you'll have to pay to yourself because you only gave one ticket away. Yeah. So the probability that you lose is 0.1%. Let's not look at that yet. Let's focus on this. Okay. If I sell 49 tickets, the probability that I lose is 4.9%. Okay. So very likely I will have the winning ticket with me. When I sell 50 tickets, the probability that I give $1 million is only a little bit bigger. It's now 5%, up from 4.9. This is the probability of losing. Let's look at the 95% quantile. Let's look at the 95% quantile. What's the 95% quantile of this situation? The 95% quantile is 0, meaning there's a probability less than 5% that I will lose any money. So the quantile is 0. Understand? What is the quantile, the 95% quantile of the situation where I sell 49 tickets? The quantile continues to be 0 because the probability that I lose any money is 4.9%, is less than 95%. Okay, so the 95% quantile is 0. What happens here? The quantile is now $1 million because there's a 5% probability that I lose $1 million. And if I sell all 1,000 tickets, the quantile continues to be $1 million because the probability that I lose $1 million is more than 5%. You understand? This is what a quantile is. This is what a quantile is, and this is what value at risk will be. Now, let me explain this in a different way. If I look at this distribution function, that's exactly what the quantile is. If this is 0.5, you look at the green function, the cumulative distribution function, and the value you have here, that's exactly the quantile. Now, this is a very nice, smooth function. When we have 1,000 tickets, we don't have this. Our distribution is not like that. When we have 1,000 tickets, it's a step function. It goes like that. Okay. So it's a bit more difficult to do because it's not pretty. Okay, but it doesn't matter. The fact of the matter is that this is how we do quantile. The quantile function, and I don't know if you have seen this in math, but the quantile function is the inverse of the cumulative distribution function. It's the functional inverse. So in our previous example of the lottery tickets, okay, what we're saying is that when I sell 49 tickets, what I'm saying is that f of, I guess, 49 tickets is the probability that I lose is, so f of 0.5, no, so f of 0.05, the probability that I lose with the quantile when I sell 49 tickets, f of that is 0. But when I sell 50 tickets, f of 0.05 is now 1 million. Okay. That is what we're saying in these words. Is that clear? I need to reshare. This is a typical concept, I know. I don't know if you have seen it before. It's the inverse of the quantile function. This is the it's the inverse of the cumulative distribution function. That's the quantile function. Okay, and this example summarizes it very well. And it's a very sudden jump. You see, you look at this, and there's a very sudden jump here and here. The reason is that we are looking at the 95% quantile. The 95% quantile is somehow the worst number in 20 days, which is about a month. So the value at risk, or this quantile that we're trying to define, is roughly the worst thing, the worst day you will see in a given month. Okay, that's if I look at the 95% quantile, but I can look at the quantile from a different perspectives. I can look, see, this is the definition. Okay, this is the definition with the 95% quantile, and this is the mathematical definition with a confidence interval, which is alpha, any number alpha, which could be like 0.05, but alpha could be any number. Sometimes you do value at risk. Sometimes you do quantile functions with 99.9% confidence interval. Okay, that means that alpha in this case, 0.001, very small. Okay, but then when it goes to the, it's always here. Okay, so 95% is there and 0.001 is there, because that's, see, this is where the probability goes. 0.001 will be right there, very close to zero. And when it's very close to zero, then the value at risk will move to the left. The lower your confidence interval is, then the smaller the value at risk will be, the bigger the loss will be. And it's defined like that. Okay, this is the probability that my losses exceed that number is exactly equal to 1 minus the confidence. 0.05. This is what investors use to quantify possible losses. This is what investors use to quantify possible losses. Let me explain this in a different way, because I want to make sure that this is very well understood. Remember this? This is the stress test. I pick a day, Black Monday. I pick a day, September 11. I pick other days. These are just individual days. If I put these days in a context, of how many other days that I have which are actually good, then these bad days will be just one of many. And this is how we build the cumulative distribution function. So the bad days will be there. The good days are here. Stress test is done here, and a stress test has no probability. We don't know what the probability of those events happening is. We don't care. We just analyze that. For value at risk, or for the definition of the losses we can have, it does matter what the probability is. And that's why this is called a risk measure. This is the difference between the stress test and a risk measure. Okay, I have it here. And this is the example that you need to remember to be able to know what this situation is. Okay, so I'm going to explain this in a different way. I'm going to excuse me. Okay, I'm back. Now I have this thing here. I'm going to come to this later. Let me skip over this. I want to explain something else in a different way now. Here's another way of doing value at risk calculations. This is another way of doing value at risk calculations. Step one is I generate scenarios, things that could happen. This is how I'm going to get my probabilities. My scenarios are in the future. They're future scenarios. Here is something that I did for bonds. So I'm using the yield curve, but it could be stocks. And then you just have to do what is the possible state that the market will be in the future. So that's the first thing. Okay. You generate scenarios. These are things, no, not things. These are possible future market states. Think of yourselves. Okay. Some of you said you think about the bad days. Some of you think about the good days. So let's generate some good days and bad days. And you do that all the time. What if the market goes up by 2%, by 1%? What if this stock goes up and this one goes down? All of those are scenarios. These are things that could happen. So you want to generate some of them. In this case, I generated 100. You generate 100 scenarios. Let's not worry right now about how likely or unlikely they are, or whether they are correlated or uncorrelated. There's no worry about that right now. Okay. So these are 100 possible future scenarios. Then what I do is I look at my portfolio, my investment portfolio, and I look at this. In each of these scenarios, I may lose money, I may win money. Let me calculate how much money I will make or lose on that portfolio. Some days I'll have gains. Some days I have losses. Okay. Some days I win, sometimes I lose. And this is, I don't know the future, but I'm thinking the future could look like this. So this is a good indication of what the future may look like. I'm trying to summarize the future into 100 situations. Then this is what my loss is going to be for each of those scenarios. And then from there, I can do P&L statistics. If I do the quantile will lead to the value at risk concept, as we already have. But we could do other statistics. We could do the standard deviation. That is also going to be a risk measure. So this process is the process that risk management is based upon. And this is where the definition of value at risk happens. So let me go beyond that. Let me ask you a question. I'm telling you, I have 100 scenarios. Could someone tell me what is the 95% value at risk of this graph? Just look at the graph and tell me what the 95 percentile is going to be. Can you do that? Are you able to do that? Take a look at those numbers. There's bars going up, bars going down. What is the 95% quantile? Let's see if I can make this bigger. Who can tell me that? What is the 95 percentile of those bars? When I have 100 scenarios, the 95 percentile is the 5th worst value. That's what 95% value at risk means. Also, is the 5th worst value. What is the 5th worst value? in that graph? Can you look at it and tell me? Write on the chat. Let's see if someone can guess what it is. Write a number. I want to know what you're thinking. What is the fifth worst value that you see in that graph? Any guesses? Anybody? It'll help me explain if you tell me a guess. Then I know what you're thinking. It's very easy once you know it, but I don't know if you understood what I said. So that's why I would like you to just write a number. What is the fifth worst day in that graph? Write a number in the chat. Doesn't matter if you're wrong. It doesn't matter if you're wrong. I want to know what you're thinking. I want to know what you're thinking. Write something, please. No? Let's look at, okay, let me ask you a simple question. What is the worst day? The worst day. What's the worst value that you see there? This is the P&L. There's profits and there's losses. What is the worst loss that you see? What number is it? No one is saying anything. Is it because you don't know? Or is it because it's very simple, this question? What's the worst number? It's either this one or that one. It's not clear to me, but it's one of those two. These are the worst. And it's about what? What number is that? Maybe 8, 7, 8, maybe? It's negative, it's down, right? So that's the worst. -8, there you go. Die, yes, -8, you're right. I think that's what it is, -8. That's the worst. What's the second worst? It's about the same. What's the fifth worst? What's the fifth worst? -6. Yes, I agree with you. I think it's -6. These are 2. Then maybe that's number 3. Maybe that's number 4. Maybe that's number 5. So that's about -6. That's what I think. Now you understand value at risk. Now you know. If you have 100 values, value at risk is the 5th worst. Is that clear? Bang, I can see you're saying yes. Good. Is that clear? You see, this is the same thing that we're doing. Yes, okay, so people are saying yes, this is wonderful. Very good, I like it, very good. That's because I have 100. That's because I have 100. What happens when I have 1,000? What happens when I have 1,000? It's not the fifth worst, it's the 50th worst. And that's where the ticket example comes into play, right? It's the fifth worst. You see, it's all the same. Now it all matches. It's the fifth worst or the 50th worst, depending if you have 100 or 1,000. Okay, so the key to doing value at risk is to have a lot of scenarios with a lot of values, like we're doing here. That's the key, having a lot of scenarios with a lot of values. The more, the better. And then when you have values, look at the losses. Don't look at the gains, only the losses. You're a risk manager. You only worry about what could go wrong. We're playing defense. So you only think about what could go wrong. And in this case, you can see that the value at risk is -6. What does that mean? I don't know. I don't know yet, but I know that it's -6. Okay. So I'm thinking that the worst thing that could happen to this portfolio is that I probably lose $6 or $6 million, depends on the units. And because this is the 95 percentile, the 95 percentile is the fifth worst of 100. What if I have 20 values? That will be the worst. The worst of 20 is the same as the fifth worst of 100 or the 50th worst in 1,000. So the worst in 20 is about the worst day in a month. So this means that when I have this investment portfolio, I should expect to lose approximately $6 every month. The worst day, I mean, I can lose more, but the worst day will be $6. Maybe I lose money every day, but the biggest loss I will see is $6. So the value at risk only measures the worst loss. The worst loss within a confidence interval, okay? Again, it's worst in 20, fifth worst in 100, 50th worst in 1,000. That's what it measures. Why do people care about this? Why is this a relevant number? Well, it's a relevant number. Maybe I give you a history of regulation a little bit later, but I mentioned something earlier, which is I mentioned Black Monday. Let me go back to Black Monday. And this was October 17, 1989. That was a bad day. That was a very bad day. And no one knew it. No one knew it was coming. But it was very bad. Many companies were bankrupt. So because of that, banking regulators all over the world, they started to think, how can they get their banks to know or have an idea of how a bad day would look like. And this is how value at risk came up. So value at risk was an attempt. Value at risk was an attempt at predicting, well, maybe not predicting, maybe preparing for days like that. And actually it was this day, it was October 17, 1989, that created the concept of value at risk. That day created that concept. When September 11 happened, the value at risk concept was already there. And banks already have an idea that something like this could happen to them, okay? So again, this is what happened when you play defense. And that's what value at risk is about. Okay? And value at risk is typically used not on investment portfolios, but on what's called enterprise-wide risk management, when the portfolio that you're considering is not just an investment portfolio, but it's the entire organization, okay? The entire organization. So this definition of value at risk typically applies to the entire bank. And it's done for banks. Insurance companies have also a version of this, but this is something that was done for banks and is typically done for the bank, but for the whole bank. For the whole bank, okay? Now, what I have to explain now is something which is a little bit sophisticated, but I want you to understand it. It has to do with this. I want to do an experiment. Imagine that I have my investment portfolio of 50 lottery tickets. 50 lottery tickets. My VAR is what? My value at risk is $1 million. We already saw that. Okay, my value at risk is $1 million. Very big. I said, what a pity. Think about this. What a pity. I have 50 tickets. If I had 49, my value at risk would be 0. You see? But I have 50. So how about if I do this? I'm going to take my portfolio of 50 tickets and I break it up into a portfolio of 25 and 25 tickets. 2 portfolios. What's the value at risk of each of those 2 portfolios? The value at risk is 0 and 0 because they are less than 50. So what I can do is I can take my bank and I can break down my bank into 2 banks. And now one bank has value at risk of 0 and the other bank has value at risk of 0. But together I have a value at risk of $1 million. Okay, this happens because value at risk, the quantile function, is not subadditive. Okay, we're going to see this now. I just try to justify this. So this is something which is, it is a consequence of the mathematical construct we have built. We've built a quantile construct which gives rise to a quantile, gives rise to a risk measure which is not subadditive. So I can take my portfolio with a lot of risk and break it down into 2 portfolios with no risk. And this, we know it's not supposed to happen. Risk is supposed to disappear when you mix things because you diversify, but it's not supposed to disappear when you break things apart. The risk could be higher, right? So because of that, there are some people who don't like this definition of value at risk. And there is another concept. Let me just move over. There's another concept which is called conditional value at risk. It's more complicated to explain. I'm just going to leave the formula here. I don't think I want to spend time on this. But there's another definition which happens to have this characteristic, which is that the in a situation like this, this doesn't happen. The conditional value at risk of any portfolio is going to be less than or equal than the sum of the value at risk of any one of its components. So it's never a good idea to break down a bank. The risk will go up, never down. Okay. On the other hand, if you have 2 organizations and you merge them, the risk will come down, never up. Okay. So this is another risk measure. It's called coherent risk measures. Coherent risk measures have this characteristic that when you take 2 portfolios and you combine into one, the risk goes down. Value at risk is the one which is used in the banking sector. It has a characteristic when you take portfolios and you mix them together, the risk could go up or down. You don't know. Okay, that's what's called incoherent. Coherent risk measures have this characteristic. So there's another way to say this, which is that diversification decreases coherent risk measures, as we saw. So an example of a coherent risk measure is conditional value at risk, yes, but also the standard deviation is a coherent risk measure. The standard deviation that we have seen many times is an example of a coherent risk measure. Because when I take portfolios and I bring them together, their value at risk comes down. We saw that many weeks ago. And when you take portfolios and you break them apart, the standard deviation never comes down. It always goes up. We saw that in the example of the snow swap. We had 100 swaps. Each of them had very high risk. We bring them together, the risk comes down. That's called coherent. Okay. Now, this definition of, again, I don't know, now this is getting very, very sophisticated probabilistically. I don't know that you have, I'm not even going to try to explain this to you. Okay. I'm not interested in that. I'm interested in other things, but this is a definition. It has to do with a conditional expectation. Okay. It's the expectation of my loss is conditional that the loss is bigger than the quantile. It just is conditional expectation. Okay. And again, I don't know. expectation. This is something which I'm going to leave in the realm of sophisticated concepts, which I just mentioned, but I'm not going to explain. I'm not going to go into this, okay? But at some point, some of you may in the future, and then at least you've heard it, okay? So this is not something that we will consider in this course, no consideration. Only mentioned. Okay, all right. Now, having said this, I want to make some remarks. The first remark is this. This is a very interesting formula that I want to spend a little bit of time explaining. This formula you can understand. And you can understand this because we have seen this formula before. I remind you that we saw a formula like that. When you have a portfolio that invests on assets with certain weights, then the variance covariance matrix gives me the standard deviation of the whole portfolio. This is a formula that we have seen before. We have seen that formula before. You may remember or not, I'm not sure. Okay. And I remind you that this is equal to the correlation between I and J multiplied by the individual standard deviations. Okay, that was the definition of covariance. So look what I'm doing here. Actually, I am not doing this. A person by the name Longin did this in the year 2000. He said, and this is not a formula, it's not exact, okay? This is not a formula. It's not exact. It's a proposal. It's a proposal because calculating value at risk is difficult. Calculation of value at risk is difficult. And sometimes you're in the situation where you know the value at risk of the components, you just know the value at risk of the sum. Okay. So what Longin said is that this is like, it's not equal, it's like this expression that we have here. And if you note, this expression is the same that we already knew, where we replace, the weights are the same, and we replace what was the standard deviations of each investment by the value at risk. Everything else is the same. You see, everything else is the same. Everything else, oops, there. Everything else is the same. So what Longin is doing is something very interesting. Is oops, it's gone. Sorry. What Longin is doing is taking this formula we already saw. Well, just she's taking this formula we already saw. We saw this formula before, and it's making an analog of it where sigma is replaced by value at risk. And like I said, this is not, it's not equal, it's a replacement. Okay. And the reason is that this is hard to do. This is hard and this is easy. That's why he's proposing this. But it's a proposal, it's something that people do. And the reason is that value at risk is very hard, very hard. Okay. Very hard. However, there is a situation when value at risk is very easy. There is a situation when value at risk is very easy. If my portfolio, so let me, I don't know, this is advanced, and I am not going to be very interested in that you're able, that you know this. Okay, this is just something that I want you to know. This is the end of my risk management chapter anyway. Okay, so this is a bit advanced. I want to spend 5 more minutes on this, and then we're done with risk management. Okay, from this perspective, but at least I want to tell you these things. There is a situation when value at risk is very easy to calculate, and it's this one. Let me go back to the definition here. When I have this is my definition of value at risk. The probability that my losses are bigger than the number is 1 minus alpha. If my portfolio, if rho is Gaussian, then this is easy. Because value at risk is the cumulative distribution of the Gaussian applied to that number alpha. In other words, let me go here. It's easier to explain here, okay? If this is Gaussian, or if this is Gaussian, then the value at risk is easy because it's the cumulative function of the Gaussian. It's the cumulative function of the Gaussian. The cumulative function of the Gaussian is by definition exactly that. It's the integral between minus infinity and alpha of b to the minus x squared over 2 dx over square root of 2. Okay. So when it's a Gaussian distribution, then the value at risk is very easy. That's if it's Gaussian 0, 1, and if it's Gaussian with a different standard deviation, just multiply by the standard deviation. So this is very easy to do if it's Gaussian. So because of that, okay, in the case of Gaussian, there's a very simple expression. It's the value at risk of the Gaussian distribution is the standard deviation times the quantile of the Gaussian, which is known. For example, the 95 percentile of the Gaussian is 1.65, or the 99 percentile of the Gaussian is 2.33. These are known, right? So for the Gaussian, if you want to know the standard deviation, if you want to know the value at risk of a Gaussian portfolio, you just multiply 1.65 times the standard deviation, and that's it. That's exactly what the Gaussian is. Exactly. Okay. That's in the case of a Gaussian. By the way, because of that is because it's why Longin came up with this example. Oops. Yeah. Because for the Gaussian, this is exact. For the Gaussian, this expression is exact. So what he says is that if it's non-Gaussian, then it must be approximate. If it's non-Gaussian, it must be approximate. That is his thinking. Okay. And it's all based on the fact that on the Gaussian, the value at risk is very easy. Okay, so I'm going to end with something very sophisticated, but I'll just tell you and then we'll forget about it, which is there is another approximation. This is also another approximation, okay? Approximation, which is if you have a distribution which is not Gaussian, then the value at risk will be similar to what we have here. You see, this is the Gaussian part. It's the same, yeah? But if my distribution is not Gaussian, my distribution will have a skewness and a kurtosis, which are not zero. We saw the skewness and kurtosis several weeks ago. You may forget what they were. It's okay. This is something which I'm just going to mention, and then I will end it here. If this is my skewness and that's my kurtosis, then the value at risk for a non-Gaussian portfolio will be like this, and it's an approximation. It's not an exact formula, which uses the skewness and the kurtosis as the elements for it. Okay, so this is very sophisticated, very advanced. I'll just leave it here. I'll leave it here. I'm not going to say anything else about it. Okay, but I want to use the last 5 minutes in my class to tell you of everything we saw today. There's one thing that I want you to remember. Only one. I want you to remember. And that is that it's very important to generate scenarios. It's very important to generate scenarios so that we have an idea what might happen in the future. Okay, and I'm going to use my sports analogy. Some of you play sports. When you play sports, you generate scenarios all the time, don't you? When you play with an opponent, you generate scenarios. You play chess, you generate scenarios. You play basketball, you generate scenarios. That's when you're in a certain part of the field, because you think something might happen here or something might happen there. You're always generating scenarios when you play sports. When you invest, you also have to generate scenarios. The question I have is how do you generate scenarios? We know why we need to generate scenarios now. Because generating scenarios, once I know the scenarios, look, I have the scenarios. So once I have scenarios, I can think, I can see what bad things could happen. And when you're playing sports, same thing. Once you generate scenarios, then you can play better. If your scenarios are very good, you will play better than if they're not. If you do not generate scenarios, the opponent will generate scenarios for you and you will lose. In investing is something similar. So the question is now, how do we generate scenarios? This is clear. History. History is one way of generating a scenario. Just see what happened in the past. That's one good way of generating scenarios, history. And if you generate historical scenarios, this is historical. Distributions. And it's very good due to historical distributions. And if that's historical, when you do your value at risk, this is historical too. So you generate your scenarios by looking at history, then you can do some value at risk, which will be based on history. But can you generate scenarios in a different way? Can you generate scenarios which are not based on history? Can you do scenarios which are new? Never happened before. Can you do that? The answer is yes. The answer is yes. And that's what we're going to be seeing next week. We're going to be focusing on the concept of how to generate new scenarios. And these are new scenarios which are important not only for risk management, but also for investing, because we want to know what might happen in the future. You see, a lot of what we have seen in this course is based on probability and statistics. And it makes a difference if the probability and the statistics that you use are based on what happened in the past or what might happen in the future. So starting next week, we're going to adopt a different perspective, which is forward looking. We're going to start trying to generate scenarios in the future that never happened. It looks like magic, but it really isn't like magic. Of course, we're going to use history to learn, and then we're going to generate scenarios for the future. Machine learning does it very well. I'm not going to do machine learning in this course, not yet. No, I'm not going to do machine learning in this course, but we're going to be forward-looking, not guessing, Guessing is very difficult, okay? If you're playing sport, you don't know what the opponent is going to do, but we're going to imagine. We're going to see what might happen and see that we can learn a lot from being able to imagine what might happen, because that will allow us to do all these things we have done today in a very quantitative manner. Okay? That's what we'll be doing next week. Now, let me do one thing. I have to stop this share. And I want to tell you that there is I've included a new lecture note on my website that you can download. It's this one. There's a new lecture note. which is called Monte Carlo. Monte Carlo is the name. Monte Carlo is the name we're going to be using for generating scenarios. Okay, it's on the website, you can download. And that is what I will be doing next week, which is not magic, but is like magic. We will be generating scenarios so we know what might happen. That has never happened before. Okay. Okay. So for this week's assignment, what I will do is I will give you the next step in your construction of the risk parity portfolio. This next step will be the one that will finish it, I think. At the end of it, you will have finished the construction of the risk parity portfolio. Once we have the risk parity portfolio, I'm going to do some risk management exercises on it. That will be the next assignments, and that will take us to the end of the course. Okay, so the end of the course is now near. All right, I still have 2 minutes, but are there any questions? Today, remember, we saw the analogy between investing and playing sports. And it's all based on how you generate scenarios. So I'll give you some advice. Next time you play sports, I don't know when that will be, that you can actually, maybe you play sports in your room, I have no idea. But next time you play sports, I would suggest think when you're playing sports about scenario analysis, what I told you today. Because if you don't play sports through scenario analysis, that will make you a better sports player. Good sports player generate very good scenarios. That's why they're good. Whether it's chess, whether it's badminton, whether it's basketball. Okay. The advantage we have when we're doing investing is that we can generate scenarios with a computer and we can take time. When you're playing sports, you have 1 second, maybe less. And you have to generate a lot of scenarios and then move quickly because something might happen.